All right, let's talk mortgages. Getting a home loan, it can feel like you're trying to learn a whole new language, right? So many confusing terms, so many hidden details. Well, today we're going to decode it all. And we're going to start with the most basic, most important question there is.
I mean, it seems simple enough, doesn't it? You borrow the money, you pay it back. Easy. But it's actually a little more complicated than that. And honestly, answering this one question, that's the key to understanding everything about your mortgage.
So let's start by dissecting a typical monthly payment. We're going to break down exactly where your money goes every single month. Okay, so your house payment, it's usually way more than just paying back the loan. Most of the time, lenders bundle everything together into this one tiny little acronym, PITI. And no, that's not the feeling of pity for your wallet, though let's be real, sometimes it feels like it.
So what does PITI stand for? It's principal, interest, taxes, and insurance. The principal, that's the actual cash you borrowed to buy the house. Interest, that's the bank's fee for letting you borrow their money. And then you've got the T and the I, property taxes and homeowner's insurance. A lot of the time, the lender just collects that money from you each month and keeps it in a special account called an escrow to pay those bills for you.
So how in the world do you pay off this huge loan over, say, 30 years? It feels impossible, right? Well, the magic behind it is a process called amortization. It's a fancy word, I know, but all it really means is there's a system for how your payments are set up to slowly but surely chip away at that mountain of debt. And this is where it gets really interesting. Look at how that balance shifts over time. Check out payment number one. Whoa. Almost all of your money is going straight to interest. The bank gets paid first. But then you fast forward, look at payment 203. You've hit this awesome tipping point where more of your money is finally going toward the principal, the actual loan. And by the very end, say payment 358, it's almost all principal. You're just knocking out the loan. That is how you build equity. Okay, so now we get what's in the payment. Let's talk about the loans themselves. There are a bunch of different types out there, but you're pretty much always going to start by choosing between two main flavors. And really, this choice boils down to one thing: stability versus risk. With a fixed-rate loan, it's exactly what it sounds like. Your payment is the same on day one as it is in year 29. It's predictable, it's safe. But then you have the adjustable rate mortgage, or an ARM. And this one, it tries to tempt you with this really low initial teaser rate. The catch, after a few years, that rate can go up or down with the market. So yeah, it can be great if you know you're going to sell the house soon, but it definitely carries more risk in the long run. All right, so beyond those two big ones, there are a few other specialized loans you might hear about. Let's do a quick rundown so you're not caught off guard. First up, the balloon loan. This one tempts you with these nice, low monthly payments, but there is a massive catch. After a set number of years, boom, the entire rest of the loan is due all at once. It's a strategy some investors use when they plan to flip a house fast, but for a regular homeowner, it's a huge, huge financial gamble. Next, a blanket mortgage. Now, you probably won't run into this one yourself. It's mostly for big developers who need to finance a bunch of properties at once, like a whole subdivision, all under one big loan. And then there's the reverse mortgage. This one is specifically designed for older homeowners, usually 62 and up, to help supplement their retirement income. It basically lets them turn the equity they've built up in their home back into cash, and the loan doesn't have to be paid back until they sell the house or permanently move out.
Okay, we need to shift gears for a minute and talk about something really, really critical. Because understanding all this stuff isn't just about finding the right loan, it's about protecting yourself from people who might try to take advantage of you.
And that brings us to predatory lending. It's exactly what it sounds like. It's when shady lenders use unfair, deceptive, or just plain abusive tactics to trap people in loans that are terrible for them, but incredibly profitable for the lender. Just look at this. It's a real-world example of one of the biggest red flags you can find: lending to someone without caring if they can actually pay it back. In this case, a lender approved a loan where the guy's housing payment was 79% of his income. I mean, how can anyone survive on that? It's just setting them up to fail. And here's another nasty trap. This couple had good credit. They did everything right, but they were stuck in a high-interest loan because of something called a prepayment penalty. That's a huge fee you have to pay if you want to pay the loan off early. So even though they could have gotten a much better rate, it was going to cost them over $7,000 just to get out of the bad loan they were in. So what are the red flags you need to watch out for? Well, first, be suspicious of anyone who keeps pressuring you to refinance over and over. That's a trick called loan flipping. Second, watch out for crazy high fees. They should be around 1 to 2% of the loan, not 5 to 8. And as we just saw, be so careful with prepayment penalties and any weird single premium insurance they try to roll into your loan.
Now, this is related to predatory lending, but it's a little different. Let's talk about outright mortgage fraud, because it can actually come from both sides of the table.
You've basically got two flavors of mortgage fraud. The first is fraud for housing. That's when a borrower maybe fudges the numbers on their application, like their income, so they can qualify for a house they really do plan to live in and pay for. The other kind, fraud for profit, is a whole different beast. That's usually a complex scheme run by industry insiders to just steal a bunch of cash and equity from lenders, and they have zero intention of ever paying it back.
So after all that, what's the big takeaway? It's pretty simple, actually. Your single best defense against bad deals, predatory lenders, and fraud is knowledge. Just knowing what you're looking at, understanding the language, that's where the power is.
So, I'm going to leave you with this thought. Now that you've seen how these loans are put together, and more importantly, where the traps are hidden, you're not just a borrower anymore. You're an informed consumer. So, my question for you is, what's the first question you're going to ask when you sit down with a lender?